Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Mish Schneider, Director of Trading, Education, and Research for Marketguage.com on the show. Mish, welcome back.
Thank you. Thank you very much. Good to be back.
All right. Everything we had talked about in the past seems to have come to fruition, but you and I know that. Let's walk through these markets that you're trading and show the viewing audience what we're talking about.
Yes, and so 2 weeks ago, when we on Halloween actually, we talked about the fact that there was that tradable dip, and then we talked about it last Wednesday, which was 11/7, that it was time to sell, that the dip was over. In terms of the dip, the buying was over and it was time to sell. And boy, were we absolutely correct, because everything had rallied right into resistance. And as we know, things are starting to fall apart right now. So to also recap a little bit, so people who are first listening in know what we're going to cover today, is we made those predictions based on a few things. Number one was the modern family, the sectors that we look at with the one index. Number two was what we call the triage of influences, which would be oil, the dollar, and the interest rates. And so we also talked about commodities and the ratio between stocks and commodities, and how that was starting to show a little bit of a buy after being at a low for 100 years. And so everything that we talked about, and that's why you mentioned that, is coming to fruition. But it doesn't mean that anybody who's coming in now and listening for the first time has missed the boat.
Got it. What markets do you want to start with?
Well, let's go through the triage, because what we talked about a couple of weeks ago was that what was safe. We said equities were unsafe at the time, the metals were unsafe, even the agriculturals were unsafe, the bonds were unsafe, and things have shifted a little bit. So with the pressure that we're getting from the global scene, particularly Germany's having trouble, Japan's having trouble, and now it's trickling in, and of course there's all kinds of conversation about Brexit, what's going to happen with England. We finally starting to see some pressure in the United States. It had to sort of roll over. So if we look at that triage right now, we have the dollar. Now the dollar went up to new highs just 2 days ago. New highs not forever, but new highs for 2018, or a multi-year high actually, and has retreated since. That's one of the things we talked about. How much higher can the dollar go, and what is going to sustain it, considering the fact that a lot of economists right now are calling for a recession within the next couple of years. We talked about the rates, that Powell and his chair people are in a pickle. They're in a pickle because when the market goes down, everybody's used to the rates starting to ease. But because we're at that precarious 2%, remember we also talked about how inflation doesn't necessarily behave itself the way people want it to, that if they actually started to ease on the rates, it could spark inflation. And then we talked about oil, which, crashed, has a little bit of a bounce today, but not very much. It's really, really broken down. So put that all together, what do we have now? That sparked a rally today in the metals, which makes sense. And the modern family characters, which would be the Russell 2000 as the index, went into a death cross for the first time in about 2.5 years.
That is impressive. What do we do with that?
Okay, so in terms of the dollar right now, and I'm using UUP instead of DXY, just because, it's an ETF, and I always assume that people, when they're trading during the U.S. hours, prefer to trade the ETF as opposed to the futures. That may not necessarily be the case for everyone, but I like to use that. So now 26 is your real wall of resistance in the UUP. And 25.76 is where you have the most, the fast moving average, which would be a 10-day moving average. If that continues to soften, we've got issues. We've got issues, obviously, as we're talking about it, because the market is under pressure and because inflation now is going to start to peak up a little bit. With the rates, it held 112. It broke down under 113.50. Yesterday, it took out 113.50. And now, right now, TLT Ts are trading 114.50. What are they going to do? Are they going to raise in December with the market under pressure? Most likely not. So now is the time where you don't necessarily look at oil because it kind of had its run, unless the situation changes and it really starts to stabilize, but you're looking at the metals and you're looking at some of the agricultures, and specifically things like sugar, which is often a first indicator of any kind of inflation that might be coming up on tap.
Exactly. Do you have an ETF symbol for sugar?
Cane, believe it or not, C-A-N-E.
I see a little bounce here that's happened. You still need a little more
Oh, yeah. I mean, but it really looks kind of like it's been trying to bottom.
Yes.
Yeah. And what's so interesting is let's take a look at silver.
Mm-hmm.
If you look at the silver market, and again, let's look at SLV, which is the ETF. In 2015, the silver low was 1304. This year, twice, we've made a low of 1311. Mm-hmm. So it was just a matter of what was going to spark that coming up from its lows, and today was the perfect scenario. The dollar softened and the rates eased. So now that's kind of the trend we're going to look for in terms of the commodities versus the equities.
I got it. So continued higher trends in the metals. It looks like gold's leading the charge on this one when it comes to gold and silver.
Which makes sense because silver has industrial uses. It's not just an inflationary hedge, where gold is really where people will flock for safety, and when, especially if they're starting to sniff inflation could get out of control.
I made a point with a person that was on the show with me a while ago. Is, you know, when people get scared, they buy bonds. When they panic, they buy gold. And it looks to me like we're getting a lot more action in the gold market these days. Do you see that what's happening in Europe with their economy, their geopolitical systems, that they're having issues, that this is going to bleed over into something that could really turn into a bigger economic issue than most people think of at this point?
Well, yes, and I think there's also a political component to that, because our administration has made it very clear that we are separate from everybody right now. And so, you know, you have Europe nervous about that on an economic level, of course, because, you know, we are a global economy, regardless of what the administration says. Mm-hmm. And secondly, is that if we do become more nationalistic as opposed to globalistic, then really what are we doing? We're isolating in a scenario where we already know that China and Russia have reduced by half buying back our debt. And there's still that talk of the dollar becoming losing its status as the world currency. These are things that would not bode well for the United States.
I agree with you. Do you have any thoughts in regards to price and time targets with any of these that we're talking about right now?
Well, because the gold and the silver have probably huge short float, I don't have those numbers off the top of my head.
Sure.
I would imagine that you can get something really dramatic very quickly. I mean, I've been a gold trader for, lots and lots of years. And I know when it gets going, it gets going. I mean, you know, you could forget about charts. It just sort of runs on its own fumes. So it's possible that we can see gold now that it just crossed the 50-day moving average today, and if it settles there, we're going back into a recovery phase. Mm-hmm. It's possible that we can see it go up to its bigger resistance up around 119, 120 if we're looking at GLD. Mm-hmm. It's possible we can see silver quickly get to $14. Which is not even that far away. Right now it's trading at $13.32. So I think, you know, you have to look at it in terms of stages, but once you start to get that velocity, the RSIs or the relative strength indicators right now are low. Yeah. As I said, big short float. And for the first time, really, even though we've been anticipating this, it's actually coming, as we said, the word, we'll say it again, fruition, in that, you know, the market's in trouble. People are saying, oh my God, what is the Fed going to do now? They're going to lose control of this whole situation.
Now, one of the things we spoke about last time was the stock market. global equity markets, and let's just, for now, if I may, just stay with where we are with the U.S. stock market. I'm going to bring up the S&Ps. We had a pretty good pullback today.
Yes, we sure did.
Give me your thoughts on that.
All right. Well,
Because that's
right
below
now,
everything.
yeah. Well, right now, well, first of all, IWM, as you know, which is the Russell 2000, is really what I consider to be the barometer of the U.S. economy because of the small cap stocks manufactured in the United States, everything we've talked about over the last few weeks. And that had the death cross yesterday. So SPY is in a distribution phase, which means it's trading under the 200-day moving average. And so is NASDAQ. And of course, we also talked about, remember, the FANG stocks, the Facebook, Apple, Netflix, and Google, that they didn't have good bottoming patterns, so that we anticipated that they would continue to go lower, and they have. So NASDAQ is also in a distribution phase. And now the Dow, which I think we also talked about, that the relationship between the Dow and the Russells, if the Dow is making new high and the Russells aren't participating, be wary. Well, that too now just flipped into a distribution phase. So that means we have a lot of room to the downside. There's this buy the dip mentality that people who have been only trading for the last 10 years are really going to be sorry if they think that there's going to be a buyable dip until we've really flushed. And I don't think we've fully flushed yet. The fear index has been there, but it hasn't really been that high yet. Today could really be the day where we start to see some panic setting in.
Yes. On that note, I'm looking at the Dow, and we've got a triple bottom somewhere around the 20, let's see, looks like...
I'm sorry, I got to move out of the way so I can put up the Dow chart here. You're saying you have a triple bottom?
Yeah, we've got a triple bottom much lower from here, somewhere around 23,000. I have 23,462-ish area.
Okay, I see what you're talking about. And in 2018, by the way, the low has been to 23,300, basically.
Right.
So yeah, so we, even if here's the thing. When we had that big crash in February, a 10% correction, and then we had another one recently, even that's unusual to have two 10% corrections in the same year if a market is supposedly bullish. So could we get back down to those levels? Absolutely. Absolutely. Plus all those 50-week moving averages, which had broken down and tried to clear last week, are now, of course, everything is trading well under it once again.
Here's the question. The $64 million question. If you are a person that normally, your grandparents made money, your parents made money, and they just lived through it and just used the stock market as a place to store the money at a better rate because things are just going up, no matter what the market saved you. All of a sudden, we may be looking at something that could be kind of a prolonged pullback, if you will, to put it politely. Do you see any industries and industry sectors, if so, that people should start calling their financial advisors and inquiring about if they're, because some people don't want to sell this stuff. They're afraid that they're going to have to pay higher taxes relative to, hey, sometimes it is time to take profit, but they just don't think that way. So they only think, I got to buy something else with the money that will offset whatever pullback we have in my normal portfolio of say, blue chip or let's say S&P based portfolios, which is kind of the cookie cutter for most financial advisors.
Well, what you're really talking about is passive investors. And that's how most people are, particularly, people who have IRAs and 401s, people who have said to me, I don't even ever open up my statements. I don't want to look because I know eventually the market's going to turn around. And that is really dangerous thinking. In terms of this particular market right now, I'll just give you a little anecdote. I happen to follow the Chinese New Year symbols in terms of the animal totems. And this year we've been in the year of the brown earth dog. But it's not just a matter of that. It's also the matter of the elements. And for the last several years, the element that the Chinese use, and I like to look at the Chinese philosophy on this because this goes back thousands of years. has been fire, which is usually very prosperous. Well, we switched in October to water. And according to the people who you look at the Chinese astrology and their totems and their elements, we are going to be in an element of water for the next 5 years. So they're predicting a bear market until about 2024, 25. So now that kind of actually even makes sense from a sort of a political standpoint too. So that's one thing to look at. So now going back to the passive investors. We talked last week about FANG. Most of the portfolios of people who have or who are passive investors included a big percentage of Apple and Amazon and Google and Netflix, thinking those stocks are the blue chip stocks, they can't go down. Well, they have. Now, if we do get any kind of sustained down move like what happened in 2008, these financial planners, they're not paid to sell. They're only paid to buy. And maybe they'll get lucky and the rates, as we said, will continue to ease and they can flock back to bonds. But we know that the Fed cannot allow those rates to ease too much because then inflation will get out of control. And even if they ease the rates, it still will have a negative impact on the stock market. So yes, I think that if you, and this is why I wrote this whole book, by the way, that's going to be coming out in the spring. If you're a passive investor and you're not calling your broker and finding out, am I invested in those big NASDAQ stocks? Am I heavily invested in the financial sector? The banking sector is getting hammered. Oh my goodness. Now we're getting a little bit, by the way, as we're talking, a little buying is coming in, but this is exactly what people are doing is they're buying these extensive dips. And then the sellers are coming in as soon as the buying looks exhausted and bringing it right back down. Oh. So that's the pattern that we're seeing.
Okay. All right. But back to my original question.
I'm sorry.
Are you thinking, that's okay, are you thinking that commodities may be the new hot sector if the current trend continues with what's going on with how the Fed is regulating the economy and dealing with the markets?
Absolutely, I do.
Okay.
I mean, I've been waiting a long time for this, actually. Not that I'm happy to see people lose money and inflation potentially go crazy. But as a trader, we try to have to keep a very objective feeling about that. And, unfortunately for people who trade commodities, they usually count on bad news to make money. So I always say the flip side to that is if you make money trading commodities, do something charitable with that money, and that kind of sort of offsets the feelings that you get because you're buying and things are really bad. But yes, I think that unless today was some kind of an aberration with the gold and the silver and the miners starting to really move way up about an hour ago, I would say that this is just really the start of things to come. The Fed in a pickle, the dollar declining, the global economy having an impact, the United States not being able to go it alone, particularly with trade wars, et cetera, et cetera. And there's been lots of rumors about the fact that we're going to do something with China, but yet they're all rumors at this point. There's no reason why commodities shouldn't be the next big thing. And particularly, as I showed you in that chart, the ratio, that what happens is those spikes in the commodities to equities ratio where commodities spike up always happens during some kind of crisis. And for the last couple of weeks, we've said the possibility of some kind of crisis is not the craziest thought in the world.
Okay. So we should start, if you're a longer term investor, not a market timer, not a day trader, if you're looking to protect the assets that, in the last couple of crashes took away and not have to sit through a 12-year recovery period, if I'm getting this right, you're saying you should really start to investigate the commodity markets as a way to diversify your portfolio, inflationary positive investments is what I'm hearing. Am I correct?
Yes, and okay. Why even believe me? Let's talk about one of the most famous traders in the world, which is Ray Dalio from Bridgewater Associates. He has had a portfolio holding on to the metals for a while. He's actually sat through this downturn and has kept his positions in the metals because he has actually been calling for some kind of debt crisis for a long time. And so take it from somebody who's a multi-billionaire, we're sort of on the same side here.
right? Well, you got to go with the money. Mish, thanks for being here today. I appreciate that.
You're very welcome. Nice to see you again.
You've been watching
Thank you.
CEO, you're welcome. You've been watching CEO Money with Michael Yorba. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.